Welcome, ladies and gentlemen, to the C2FO webinar Economic Update, the Great Rotation, Where is it taking us? Moderated by Eric Kelley and Chris Atkins. Today's session will cover key economic variables such as consumer confidence, labor statistics, global debt, as well as COVID-19 and a conversation about the outlook of the US economy. Because of the number of attendees in this session, your respective microphones have been muted. If you have questions at any time during the course of the event, please use the chat feature located at the bottom of this application window. Our moderators will make the attempt to address your questions as part of the content presentation. And time permitting, they will also address questions that have been submitted towards the end of this event. I am pleased to welcome Chris Atkins to the panel. Chris leads the C2FO Capital Finance team, which focuses on serving C2FO customers by fulfilling out-of-network capital needs via lending and factoring facilities. Before joining C2FO, Chris was a private equity and debt investor at Main Street Capital Corporation. Previously, he worked in the banking industry as a regulator with the FDIC and an officer at First Bank. Chris, the floor is yours.
Thanks, Matt, and welcome to all attendees. We have a solid presentation here by Eric Kelley up to come. We're super excited to be joined by him. He's shown to be an astute observer of economic conditions, and I think you'll agree with me by the time that we're finished here. And he's prepared a great analysis of where we're at in the current economic cycle and the recovery from post-COVID conditions. A quick intro on Eric. Eric's been with UMB for more than 20 years, with most of that time being spent in the asset management area. He's currently the Director of Research and Fixed Income. He's responsible for oversight of the fixed research or of the research department and directs product development and strategy for the fixed income group. Eric also sits on the bank's ALCO committee and economic research team. So Eric, with that, let's go ahead and get started.
Sure, thanks, Chris. Glad to be here today. And our theme right now for the economy, what's happening so far this year is rotations. And so we're going to talk through several of the topics that we think are in the process of rotating in almost all cases into what we think is a very positive direction. So we'll talk about COVID, how we've really rotated from talk about cases to talk about vaccines, which is a great thing. The economy is rotating into a reopening phase. It's slow, but it's steady. Of course, Washington, we have a complete rotation in Washington to some new regimes, which again, there's some positive and negatives there. And inflation is rotating into focus, that's for sure. And we want to at least talk about what we think the outlook there is. And long-term inflation can be an interesting issue. We'll also talk about the stock and bond markets briefly at the end and go through our forecasts and let you know what we think is going to happen to rates and markets so far, or by the end of the year, this year, actually. So we'll start out talking about the positive rotations, the things that we think are really painting a pretty darn positive picture for the remainder of the year this year. And the first one, of course, is COVID. Everybody knows that this chart, we've seen it on TV. There's a lot of different folks creating this thing, but this is the daily change in COVID cases. It's been a really great story since the vaccines were rolled out. We all know that it's moving pretty rapidly on the vaccines. The case rate did start to move up a little bit. We're having some fits and starts in different areas of the country. This is actually a little bit dated. Since this was printed, we had 5 or 6 declines in a row. We had a case rate of only like 42,000 just the other day, one of the lowest numbers we've had. So we believe that the COVID story is positive and heading in a very positive direction because of what's on the bottom. It's vaccines. Everyone is involved in the vaccine chase right now. Fortunately, I've already gotten mine. We're way above this number that you see here. We hit a daily vaccination rate of north of 4 million. It was last week or the week before. So it's building steam rapidly. That's good news. There's going to be pockets of challenges and dark news stories around this as we roll. But in aggregate, this is definitely rotating in the right direction. And we'll try to illustrate that to you with what consumers are doing and thinking about all this. And it all looks very positive to us. On to the next slide. Some of the places where you hear, and I apologize, this is a little grainy when I expanded it out, but you hear talk in the media about, well, my God, look at the United Kingdom. They just went into another shutdown. And this is their vaccination rate. You can see it's dramatically higher than the United States. yet they're going back into a shutdown mode. But if you really dig down into the numbers, their case rate is nothing like the United States. They have a very low case rate. I mean, when we checked a couple weeks ago, their case rate was like 4,000 a day, 1/10 of the United States. They have some variants that are showing up, some mutations that they're worried about. And generally in Europe, they move more aggressively around this topic of shutdowns than we do in the United States. So the current story coming out of the UK and Europe, it sounds a little painful and a little frightening, but we still think that the data is there, that the vaccines are working and they're getting us in the direction of some type of reopening in the back half of the year. We'll move on to the next topic. We think that the consumers are showing us that we're right about this when you start to dig into some of the information. And we like to look at this stuff called high frequency data. This stuff comes out in most cases daily. It's not just once a month like a lot of the other things. And in all cases, it's really moving higher as the vaccines have rolled out. This is several different things. The Dallas Fed mobility indicator. And yes, the Fed tracks our cell phones. They are watching our movement. So they know where people are going. And when people are out going around, they're spending money on things. So mobility is definitely increasing. You see here, this is open table, and this is not carry out or anything like that. This is actual seated diners, people going into restaurants. Big increase there. Retail traffic on the bottom left, and that's traffic, right? A huge increase there. And even TSA with the airports, we've had a very nice increase in TSA throughput. I think we set a record on Good Friday. I think it was 1.6 million people went through TSA on Good Friday. So even the airlines are coming back. Now, of course, this is not anywhere near where it was way back in 2019. We're not all the way back there, but our theme is consumers are telling us the vaccine story is making them more comfortable moving around. They're starting to move around and they want to get out and do things. And so we think that this stuff proves that the track that we're on is positive, and it sets us up for a really good back half of the year.
And Eric, on this slide, obviously retail near and dear to the C2FO network, as it has a pretty big concentration in retail. Do you expect the retail traffic year over year to get positive in the next quarter or so?
Next quarter might be a little strong, although, when you go year over year, the nice thing we have right now in all year over years is we're comparing to the worst part of the recession from last year. So it's called a base effect. We have a wonderful comp from last year that was unbelievably low. So it's not hard to show year over year growth. So it'd probably be a good year over year comps, but we think it'll get into pretty serious numbers, seriously positive numbers in the second half of the year, Q3 and Q4. You get to late summer, we expect it to be very healthy because we're expecting a big GDP number for this year. So yeah, positive, but Q3, Q4 even more so. We always take a quick peek at the unemployment rate. We have to do that. It is part of the story, but everyone on the call probably knows the unemployment rate. It's a little cloudy, and there are arguments about how some of the data is collected, that's for sure, but it's the best measure we have of unemployment. And you can see it's dropped to 6%. It's been a fantastic drop from where we were, back down to 6%, way above where we were before, though. We were below 4%. Let's just say in the good old days, 2018, 2019, we're still way above that, but it's been a wonderful drop. And the same thing with these jobless claims. They got so high, they got off the top of our scale here, but they've dropped down. Again, though, jobless claims, it's not like we're out of the woods. Jobless claims are still higher than they were at the peak of the last recession. Now, there's a lot of extra stimulus and a lot of extra jobless dollars out there. So that helps keep jobless claims high, but we're going in the right direction. This slide also, it tells us two things. We're going in a wonderful direction, but this big gap here between, call it 6% and 4%, and down here between 700,000 and what might be normal around 350 or 400,000. There's a very big gap still to cover there. There's a lot of what we call slack, a lot of slack in the jobs market. There's a lot of people that need to get back to work and need to be pulled off the sidelines. So as good as this story is, what goes along with that is it makes it harder for real inflation to develop when there's this much slack in the jobs market. So the inflation story we'll talk about in a minute or two It's real and it's coming, but we think it's quite a ways out because of what you see on the screen right here. So much slack in the jobs market. And here's just some other data that tells you, just corroborating how much slack there is there rather than just looking at the unemployment rate. 8.4 million fewer people working. Just how many people are working compared to before? The labor force participation rate on the right-hand side, it's a hot topic, and it's a extremely challenging academic topic, but just the number of people that report, that are of working age, that report that they're looking for work, they're working or looking for work, it dropped dramatically, and we're still almost 2 full percentage points below where we'd be normally. That's millions of people. That's millions of people that are not in the labor force anymore. They're not working or looking for work. So that gap right there has to be crossed somehow, because not all of those people just retired because of the recession or COVID. There's a few million people that ultimately need to get back into the workforce. So that's all part of that gap that we need to cover before we have a threat of real inflation, really sticky or sustainable inflation.
So Eric, what will you be looking at on those two charts? What will you be looking at in terms of, will you be looking mostly at unemployment, or will you be looking at it in conjunction with the labor force participation rate to really understand how the recovery is taking hold in the second half of the year?
Yeah, the labor force participation rate is also kind of a slow moving. It's a slow moving figure. I mean, we get reports monthly. We have to look at them at the same time. They're going to oftentimes move in tandem, but a big increase in the participation rate will keep the unemployment rate from falling, because a whole bunch of people can come out and get new jobs, but your unemployment rate can stay steady. So if the unemployment rate, for us, if the unemployment rate kind of stalls and maybe let's say goes down to maybe only 5.8, but we've had a nice big uptick in the participation rate, that tells us that's great news. There's a lot more people being pulled back into the jobs market. So we want to see both of them. We'll see both of them moving. We want participation rate coming up, and then the unemployment rate coming down, and then we'll be on our way back to what they call full employment. So it's really both. And yeah, of course, when you look at these previous two slides, you say, well, this is just a measure of the demand for workers, the JOLTS job opening rate. It's off the charts to the high side. There's a lot of people looking for workers that can't find them. It's everywhere. It's impacting a lot of industries, which it's interesting because you would think that people would, if the jobs are there, people would want them, but that's the nature of this cycle with the stimulus. Politically incorrect. There would be some who would say we're incenting people to not go back to work, and that's why you have this chart looking the way it does, with just a huge jobs opening rates. This is normally a precursor to inflation, and it's this hard to find people, but we know there's that big pool of several million people that will get pulled back in at some point. So this isn't really an alarm for us yet, but it does confirm it's hard to find people in a lot of different sectors.
And so the message to hiring managers here is, Eric, is post early, right? Because if you're looking for somebody, so is everybody else. So you got to get to it earlier than you maybe thought you did.
Absolutely. And if you're looking for skilled, which probably everybody on this call is, if you're looking for skilled, it's even worse. It's tough. The skilled workers stayed fully employed. There's kind of a glut of the just below skilled, but and I know those are kind of soft terms, but no matter where you look, post early and probably be aggressive. And as the economy heals, that is the kind of thing that could put upward pressure on those wages we have to get people back in. So be ready for all that. We always take a peek at confidence. We've looked at this each time we've talked. Confidence looks pretty solid. The first bar here is just simple consumers, everybody. And it dropped off on the right-hand side during the recession and is slowly working its way back up to relatively strong levels. The consumer confidence number looks good. Small business is right in the middle. This is genuinely small business. This is people with employee bases of 15 or 20 employees. Same thing, it dropped off and it's recovered somewhat. And small business, I think, is just lukewarm. I think most small businesses don't know exactly how to look at what's happening right now. CEO confidence on the bottom. This is the big guys. This is Fortune 500 CEOs. They've had a massive increase in confidence, the highest levels on record, highest readings on record. They're absolutely confident that things are going in the right direction globally. And that's a very, very strong number. We always go back a little bit deeper into manufacturing. Manufacturing is not a big part of the jobs market anymore. It just isn't. It's not a huge part of the economy, but it tends to be a great leading indicator. It still is a good leading indicator for where we're headed. And all the manufacturing data is very positive. China on the top, they recovered very quickly as far as their manufacturing indices. United States in the middle, this is the United States Purchasing Managers Index. Huge recovery. Again, 64.7. If you look at that across there, you're back to multi-decade highs on what U.S. manufacturing executives are saying about their outlook for business. Same thing comes through to us on our commercial lending side. We're mostly a commercial bank, and our board members and our major commercial partners they're optimistic. So it all is corroborating the story that we're talking about. Services is what's on the bottom. We're a 70% service-based economy. We're not very heavy in manufacturing anymore. So we look at the services indices as well. They've also recovered. We just want them to be above 50. That's what indicates expansion. And it's well above 50 and hanging in there. So all of this background data that we dig into confirms that it's reasonable to be optimistic for probably the next at least 12 months. A lot of what's happening with consumer is driven by what you see on this screen right here, the next two screens. I think we talked about it last time we got together. This is good information. It's good news. It might upset people maybe philosophically or politically with what this illustrates, but it is good information to know. And this is household income, U.S. personal income. And I think, as we pointed out last time, we just wanted to update the numbers. But for the first time in history, we went into a very serious recession, completely unexpected, a black swan type of event. And for the first time in history, household incomes went up, and they went up dramatically. They didn't continue to climb on their normal trajectory, which is 3 year or something like that. We had a massive spike in household incomes because of $2, $3, $4, $5 trillion in checks that just get sent out. That's included in this income. Transfer payments are included there. So we had a massive increase. The program started to taper off as we got towards the end of the year. But even as we got to the end of the year and the programs had largely completely tapered off, incomes were still above where they started. And of course, we got another round of stimulus, and we have a couple more rounds coming after that. That is good news. At the very least in the short run. That's part of the thing that gets those consumers confident and feeling comfortable to go out and do the things that they're starting to do, which is buy goods and services. And on the bottom, when you have this much stimulus and this much increase in income, when your economy is shut down, it causes a huge spike in savings. And that's exactly what you see here. This is a thing called MZM, the money of zero maturity. It's the broadest measure we have of all the cash on the sidelines in the United States. And you can see here, if you just look to the left real quick, we had basically a $5 trillion increase in cash reserves. Now, this is in corporations and in households. This is the broadest one. It's everything. But $5 trillion in a very short period of time was added to savings on the sideline. Our bank experienced it, all the other banks. The inflow of deposits has been a wall like nothing we've ever seen before. And you can see on the right, basically we're at 22 trillion. I think we're at 22.1 today on that number. The reason that's significant is that's larger than the GDP of our entire country. That's larger than an entire year's worth of economic activity in the United States. And we have that on the sidelines. So that's good. That's pent up capacity there. Consumers and businesses have the ability to spend a very large amount of money on goods and services when they feel comfortable doing so and when things start to open up. So it's, in the short run, that's a good thing. The next page is simply this page here I showed you on top. This includes those transfer payments, all the stimulus checks that came in, the blue line. What's really interesting is you look at what happened without the transfer payments. Just those of us who were fortunate enough to just keep working, look at U.S. income without transfer payments, and this is the chart, and it has recovered back up to above where we were when this crisis started. So even without stimulus, U.S. personal income is above where this whole thing started at, even with a 6% unemployment rate and no stimulus calculated in. Our incomes have fully recovered to where we were before this started, and that's good news. It tells us consumers and households are in good shape and ready for a reopening, and they're loaded with cash to do things if it actually comes to fruition. So that's a good
So,
story.
Eric, will we have is this a unique response to a recession, or will we have this kind of a response to each recession and it kind of make it not a recession anymore? I mean, you're talking about personal
Yep.
income that stayed consistent even though we've doubled, tripled, quadrupled at periods unemployment.
Yep.
Is this the new normal?
Yeah, that's a great question, and we've never seen anything like this before that you see on this screen in a recession, and it probably is the new normal. The only rational expectation would be that, because it's not just our central bank, Chris, it's us and everyone else is doing some version of it. We're being more aggressive than most other countries, but everybody is doing some type of stimulus like we are, direct to people into their checking accounts. So it's kind of the new game, and the central bankers are committed to it, and it certainly doesn't hurt a politician's ability to get reelected. Let's just put it that way. It helps their reelection prospects because they're keeping individuals from feeling much pain. There's really not much pain at all. So yeah, they're probably going to repeat this as long as inflation has not become a problem. So the cost of doing it hasn't run off to the moon, and that's a question mark. But if inflation is not a problem and our debt burden hasn't accelerated way ahead of all of our trade partners in the world, yes, this is how it's going to look going forward, because it's made it kind of painless for everybody. So we should expect more of this as the years go by. Not saying that's a good or a bad thing. I'll leave that up to everybody to have their own feelings about that, but this is probably the new world order that we're in. Of course, in Washington, there's a new administration with new things going on, and we just wanted to highlight what we think the best expectation is. None of this is going to be earth-shattering. We know it's going to be stimulus. Most of this has already been approved. We have this American Family Plan coming on board relatively soon. We've got almost $5 trillion in stimulus already approved and rolling, and there's going to be more. So stimulus, at least for the next 12 months, they're going to be continuing to talk about stimulus until we close the gap on some of these things and get back to normal. Fortunately, there is some talk of how do we pay for all this. That's a few months ago, there wasn't much talk of that at all, but now we are at least talking about how do we pay for all of it. And there's going to be some increases to individual tax rates, and there's going to be some increases to corporate tax rates. And we know that they're not going to be that damaging. The individual tax rates are likely to go back up on the highest end, but there really isn't any evidence out there in the data that tells us that those things are severely damaging to economic activity. Taxes at the high end tend to not change economic activity too dramatically. Corporate tax rates are the same. We know they're going to go back up, but we've been at those levels before. They're probably only going to go back up about halfway to where they were before, and we think that is priced into the markets right now. And Chris, am I still connected?
Yeah, sorry, my battery was trying to die, so I had to grab it.
Okay, perfect.
Yeah,
good. I thought it was me. That's good news.
Yeah.
Good news. So tax policy is we don't think tax policy is going to derail anything. Is it going to be new and more punitive? Yes, but not enough to slow down where we're headed. Climate policy for sure. With the new regime, we know there's going to be lots of climate talk. There's going to be subsidies and different things going on. In aggregate, that should be stimulative. So we're not negative about that. It should be stimulative, at least in the short run. And of course, infrastructure spending. If the government's going to spend money, we'd love to see them spend it on infrastructure, because infrastructure really does have legs in the long term. If it's done correctly, it can really be positive for the economy if it's handled properly. So that focus on infrastructure that they're promising should be a good thing. And there's going to absolutely going to be more focus on healthcare. Hard to say whether that's stimulative or not. That we know that there's going to be a lot more healthcare focus for sure. And this next slide, it's a reminder slide. We try to always put it in just to show people if there's going to be deficit spending, what do we want them to do with those deficit dollars? Because we're going to have to pay them back. It increases our debt. So what should they be doing with it? And this is just the spectrum of things that the federal government can do with their money. And this is what the Congressional Budget Office says is the payoff for that. And they call it a multiplier, a fiscal multiplier is what they call it. If they spend $1, does it result in $2 of economic activity or 50 cents worth of economic activity? Obviously, we want it to be above $1 or at least at $1. Anything can be very negative. You can see here on the bottom of each of these scales, if it's poorly executed, not all of them can be a bad payout, that's for sure. But they tell us, to the best of their estimations, that tax cuts, which is on the right-hand side, tax cuts tend to not have a multiplier above 1 because tax cuts tend to, particularly for the high income folks and for corporations, they tend to just add to the savings rate. What you really want them doing is what's over here on the left-hand side. In the middle is where we've been. This is just transfer payments. This is stimulus dollars, just give money to people and hope that they will spend it. That's where we've been. And it can be stimulative. It can have a multiplier of 1.5 or higher, but the most stimulative thing they can do is over here, which is all the infrastructure. These are the different types of infrastructure. So thankfully, at least with the new dollars and the new proposals, we've moved over here to these columns and we're talking about infrastructure, and it tends to build things and build productivity for the future. And so it has a much better possible multiplier. So if there is any more stimulus to come after what's already on the table now, if there's more later in the year, let's all hope that it's all infrastructure, because that really is what has long-term legs for all of us and really builds something for the future. And of course, I said we have to talk about inflation because that has really rotated right into the front and center here. And you're probably hearing about it. You're probably experiencing it. Everyone is experiencing it somewhere. If you're trying to buy a house, you're feeling it. If you're trying to build a house, you're really feeling it. So inflation has shown up as a real hot topic right now. The thing that we like to track is, which is a really good leading indicator, is a thing called inflation expectations. And there's a lot of different types of inflation expectations. This happens to be the 5-year inflation break-even rate. This comes from the bond market, and it tells us what the financial markets are estimating is going to happen to inflation over the next 5 years. And you can see it was rising throughout the year last year, but from a very low level, close to zero. On the right-hand side, it was rising as the stimulus packages came online. It was obvious there was going to be a lot more spending and activity, and so the inflation expectations were rising, but still to just very modest levels, 1.5. Then we had the election and the new regime and the assumption of a lot more stimulus coming, and then inflation expectations really took off and have risen more than 100 basis points just since the election, up to 2.6. And that's a little bit important on the right-hand side, because if this actually is, if it proves to be, as it has in the past, a really great indicator of what is going to happen to measured inflation, it indicates that over the next few years, we're going to move towards this zone in this 2.3456 range. And that's high enough that it will probably force the Fed's hand. They've told us they will let it overshoot the 2% number. They'll let it overshoot for a while. If it does get up to 2.3, 2.4, 2.5, meaning measured inflation, if it gets there, this is where the Fed has to start becoming less accommodative and perhaps raising interest rates. And that starts to change the story that's been supporting so much of this activity. But to be wide open, this is not something, remember, this is a 5-year estimate coming out of the bond markets. This is not this year. And this is probably not next year. There's pockets that are definitely feeling this kind of pressure. But as a broad economy, this is probably late next year, going into the following year, when you start to see some of this move develop. And then the talk, for our best guess, that's when the talk gets serious about inflation, probably 22 into 2023 before this becomes a problem. But it's out there. And the track record for this indicator would tell you we've got to be wise and be ready for this to come. And here's just a couple of things. If you're in the housing market, if you're trying to buy a house, or it's crazy out there on housing. On the left, and I apologize, it's grainy. Affordability is very, very good still, because affordability is not as damaged by home prices. It's really largely about interest rates. And with interest rates as low as they are, so these mortgage payments as a percent of income are very, very low. There is no supply of home, and this is home inventories divided by the number of households we have, lowest numbers we've ever seen in history. So lots of inflation and crazy things happening in the housing market, a lot happening with lumber and the commodities and the metals, but it's not happening in wages yet. So we think that's when you're going to see it. If it really gets into the wages, that's sustainable inflation that will really pull through.
Is that what will cool housing? Is wage inflation, or what are you looking for to cool housing?
No, if we had an increase in wages, it would probably make the housing market even hotter, because over here, the mortgage payments, a percent of income, would go even lower, and houses would become even more affordable. The thing that people genuinely worry about, it comes back to the same story. Almost everywhere you turn, it's inflation. If inflation comes along and this wonderful low interest rate environment that we've just all been loving has to shift, and even if it just shifts up 50 basis points is no big deal. But if something were to come and push everything up 200 basis points, that would really slow the housing market down. It really would. Now, the lack of supply would help offset that. We have a massive need for more housing for the number of people we have in this country. So that will offset even enough shift in rates, but higher rates can definitely cool off the housing market. Right now, it's so crazy, it might just get it back to normal. Most major cities, the story in the housing market is the real estate. It's nutty, the things that are going on out there. When you have a little bit of inflation, it causes rates to rise, and that's what we have on here. When the inflation story comes along and people start talking about it, it automatically pushes up long-term yields. This is the 10-year Treasury note rate. Again, like some of these, like inflation, it was basically at zero. So after the recession, coming off of these crazy low levels, it needed to rise anyway, and that's what it was doing through the middle part of last year. But then when the inflation story took off after the election, you can see the 10-year Treasury note rate really took off too and rose about 75 basis points. So that's to be expected. That's what happens when inflation starts to be talked about. And I guess you would say this is a pretty dramatic rise. I mean, it's more than 100 basis points increase in the 10-year Treasury note rate. It's more than 100 basis point increase in mortgage rates. But the reason that we're not worried about that is it is slowed down. We don't think it's going to continue at this pace at all. And on the next slide, it all has to be relative. On the way down here on the bottom right is the increase that we've had recently. But you can see we just got back to where we were before this recession started. We were basically coming off zero and resetting back to where we were before the recession started. So we're still at an unbelievably low interest rates, just incredible. So there's room for it to even move higher without it being a problem for a while.
So Eric, help for those that are borrowing. Most business loans, if they're not fixed, they're floating on either prime or LIBOR, right? And obviously, prime is going to be hinged generally to the Fed rates, right? Yep. And we've seen forecasts that show that's they say they're not going to move it for 3 or 4 years. Obviously, if inflation comes through, like you had talked about, it's going to move a little bit before that. But LIBOR does move. So kind of bring that the last 3 or 4 slides home for those that are borrowing. Should they expect in the next year that they see another 100 bips move, another 1% move up? Do you think it's going to be kind of steady? Are you really looking for the inflation number to determine that? Like, how do you think about that? What do you think?
Yeah, and that's a super hot topic right now, because we and a lot of the other strategists in the world think that the Fed's, I guess you would say, storyline right now, that is, we're not moving rates until 2024, which is what they're officially saying. We do not think that's what is going to come to pass. This whole thing is warming up, and our best guess is they're moving, in 2023 or maybe even late next year. So they're not going to stay here forever. And LIBOR is going to go away, and we're going to have a thing called SOFR after that, but that should be pretty seamless. The hottest topic at all right now is it time to term out your debt to try to get a 10-year fixed or 7-year fixed? We are dealing with that question all day, every day through our commercial lending side. So it is not at all unwise to investigate now. If whoever your commercial lending partners are, what kind of terms can you get for going to fix? Now, know that your lender is he's incented the other way. He wants you to stay floating, especially if rates are going to rise. So the terms may not be wonderful, but yeah, people should be asking about getting fixed, because you have to think about what is the likelihood that LIBOR, we know Fed funds, I guess we could say, we know Fed funds are not going down. They're not going any lower than they are. They're probably only going up. LIBOR is probably not going back down. It's probably only going up. It's the time to have that conversation with your lending partners and try to get at least some of your debt termed out. It's a wise thing to do. If you go call you guys from UMB, we'll accommodate that, but it'll be a healthy negotiation. We're getting those phone calls every day. We have a little bit of background stuff on one of the other things that drives the inflation fear for most people is what we see going forward in the long term. It's pretty hard to talk about all these kind of things and the stimulus that happened without saying, well, what does it really mean long term? And longer term, the charts are kind of challenging. I mean, this is the Congressional Budget Office own estimates of what's going to happen to the federal payments for just interest on what they've already done. And you can see what this chart looks like as a percentage of GDP. It's just a moonshot straight up. So the cost of all this debt, and this is with very little rise in interest rates calculated into it, the cost of all this debt is going to get expensive for the United States. If you have inflation and rates move like as a surprise to the upside, it'll be worse than what you see right here. And the other thing is, I think most folks are a little surprised. It's maybe a little bit less well known that Medicare is really the one on the right hand side that is a really, really big monster that's set to increase dramatically simply because of demographics. It's headed higher, and it's headed dramatically higher. So you lace all these things together, and we have, Chris, to your point, if this is the new way to get us through recessions, and it is, and it results in a lot higher liabilities for the federal government, we've got to be at least aware of where we're headed long term. We have to, because in the short run, it's working. In the long term, we start to face things like what you see on the screen here. And our favorite scary chart is what we call the Big Four chart. And if you've been with us before, you've seen this before, but these three on the bottom are what they call the Big Four out there. The healthcare is 2, it's Medicare and Medicaid. So this is 1, 2, 3, and 4. These are non-negotiable liabilities of the federal government. There's nothing they can do about these, basically. They consider these to be 100% locked in and non-negotiable, and they're growing. And all that matters here is how much income. So here's the income stream. This is the government's own numbers. You can see right here in 2021, the difference between that and this big peak up here is that gigantic deficit we racked up this year. So we're in deficit all the way through here, and we're projected to stay in deficit almost indefinitely. But if these other 4 things are growing, right now the intersection point is 2036. Just the Big Four consume 100% of the government's income. So, because up here is really the things that we really like them doing, like defense, Army, Navy, Air Force, Marines, national parks, highways, all that kind of stuff is up here. And just these 4 things will consume it all in 2036, according to their estimates. If you add in, this was done before the stimulus programs, it moves us back somewhere a little earlier in the 2030s. And that may seem like quibbling, but 2032 is 11 years away, 12 years away. So we are headed towards challenges here. If we get fantastic GDP growth, this all gets better. If we get inflation, this mostly gets worse. And the only I guess you would say, easy solution is to just raise the revenue line up. Just take that white line and move it up, and everything starts to look a lot better. Well, that's our taxes. That's us paying a lot more in taxes. So there's going to be some combination of all that. There's going to be some challenges to who gets Social Security and Medicare, maybe means testing. There's going to be increases to tax rates. There's going to be some complex math that has to be done. This is far enough out, though. 10 years is far enough out. There's not a single politician in Washington that is concerned about 12 years from now. They're concerned about the next election, which is always about 18 months away. So we have to get a lot closer to this before it becomes front and center, but it's coming. It's coming. It's not something to manage your business around today, that's for sure, but it's something to be aware of. Not the most pleasant slide. GDP, we think, is doing great. This is just the economy, and everyone knows what's happened. We had the Great Recession, and we had this long period of time where we just managed about 2% GDP growth rate all the way through the last decade. We had our big blow off, this COVID thing, and we had 1 quarter of a huge rebound, but now we're settling back down. This year, because we're coming off of a really bad year, we think you're going to have a 5.5 or 6% growth rate this year. It's going to be fantastic. It's going to be a great number for our economy. But then we're settling in to something like, we're going to call it the Great Plateau. We're probably settling back into a world of 2%, around 2%, plus or minus 25 basis points, let's say. And you know what? That was just fine. That was great for the last decade. We all made money. The markets did well. We're heading back to something that's a pretty low growth rate for the long term, but we think it'll be absolutely fine. Nothing to worry about there at all. Equity markets, we think the equity markets are doing fine this year. We're already hit. We thought just a month or two ago when we put this together, we said 7 to 11% for the year. This year, we're already there. We're at 9 and change, 9.5 or something like that. So we've already hit our total return forecast for the stock market for this year. Keep in mind, everybody, the stock market on average every year has a 14% correction. That's the average correction on the average year. So we could easily have a 10% correction and just fight our way back to where we are now and still end up having a great year. So we're positive that we're optimistic that the year's going to be good for stocks. It already has been really wonderful. And the last kind of big topic on this thing is it's all about this thing called financial conditions. The Fed talks about it a lot if you listen to them. They're trying to maintain stimulative, or what they call soft, financial conditions. That's this blue mountain chart in the background. And what they mean is they want this index of financial conditions fall. It's softer conditions. It's kind of complex, but it's mostly interest rate focused. It's treasury rates, it's credit spreads, it's availability of credit, it's banks' willingness to lend. There's currency in there. Broad asset prices are in, boils together to a thing called financial conditions, and they want it to be easing because of what you bottom. This is the S&P 500, and it basically is the same as the economy. It's a great proxy for our economy. When financial conditions are easing, the economy and the markets are doing better, and vice versa. Decade after decade, it's the same story. So on the right-hand side, you can see they've orchestrated very easy financial conditions. They're pledging to keep doing that. That means rates as low as possible for as long as possible. That could mean more stimulus. We think they will stay true to this pledge and keep financial conditions very stimulative. So we have a positive outlook for the economy and markets, 12 to 24 months. We think this story is going to play out for a while longer, if that makes sense.
Yeah, looking at this, Eric, obviously the moving from the peak in 08 on the blue mountain chart, as you called it, down into 09, 2010, that makes a ton of sense, right? Because as the financial system effectively melted down. But then I think looking closer over to the right, as we've gone through COVID, I guess with all of the money supply, you've had 20% increase in the money supply. Rates have overall gone down, and I know they moved up a little bit. And equity valuations are so far up. Is it, you mentioned, banks' willingness to lend. I mean, obviously, Chase had a report out that, even though they're trying, their lending was down, something like 50%. Is it the big banks just not showing up to lend, or is it something that's missed, or is this a really great result from the economic policy that has loosened it, and going from kind of 100 down to 98. That's kind of to be expected. Does that make
Yeah,
sense?
yeah. You see this little spike here in financial conditions, which is tightening. That's when the bombs are falling and credit is tightening up. The banks stop lending. Everyone gets scared. Asset prices roll off. That's where you have a spike in financial conditions, and the economy and the markets go down. But then, as things stabilize, the stimulus starts to come out. People feel like we're stabilizing. The banks soften up again. Their willingness to lend. The credit lending standards get softened, and then those financial conditions drop, and man, off go the economy and markets. So we've got a kind of a radical spike and rebound in there because we went through what we went through, but everything behaved pretty much exactly as the Fed academics would tell you it's supposed to behave. And that may be good or bad news. I mean, that's more fuel for them to say, we're doing the right thing, man. We're going to keep doing exactly what we're doing. That brings up some of those longer term concerns. But in the short run, the evidence is there that it did actually work pretty darn well this time.
Well,
and that's why they're going to keep doing it.
If you take it on just the S&P, so I see what you're saying. So the spike, the trough and then the spike from the trough to the peak on the S&P, that represents a 40% increase in from 2,500, near 2,500 to 3,500, and so
and we're above that now.
Yeah. I mean, I think from my perspective, as somebody that runs obviously a business within a business, and I think that this applies to those on the webinar. The conclusion to me is be bullish, right? Get after it. You've got good conditions coming up, and we should be pressing hard into growth. Any real warning signs, except for kind of inflation that you see and such coming into view multi years out? I mean, it seems like it's going to be smooth sailing, and we should all go really get after it.
Yeah. We wouldn't be quite as bullish about it. We would just say we're cautiously optimistic. We wouldn't disagree with you. We think there's reason to be optimistic that this cycle is not over, and it's going to continue for a while, 12 to 24 months probably, maybe longer. And we think it's time to get out there, invest. The things like CapEx and those kind of things, those are hugely important for long-term economic growth. And we think it's absolutely appropriate to be optimistic and invest in your company, do things that need to be done for expansion, because we think we got a couple more years of it here. Now, the boogeyman is, of course, it's inflation. If inflation comes in and snaps us with a real upside surprise, it'll make the markets jigsaw for a little while. But even that, unless it's a really severe inflation surprise, still shouldn't derail the economy. We just came out of a recession, and our economic cycles here tend to last 7 years. So what could throw us into another recession? That's hard to see unless it was just a really serious inflation spike, meaning inflation doesn't grind up to 2.3, 2.4, 2.5. The Fed has to address that. That's an okay scenario, because that means the economy has been grinding higher, and we'll all be okay if that happens, even if it's earlier than the Fed says it's supposed to. If inflation goes 2.5, 2.7, 3, 3.5, 3.7, yeah, that kind of scenario is a thing that would maybe cause a minor recession. That shouldn't be the type of thing that causes us to go back through what happened to us a year ago. That's an exogenous event that comes around once in a blue moon, and so it's time to be optimistic. It's still time to be optimistic, I guess I would say.
Because historically, and I'm not the student that you are of economic history, but my recollection is that having that kind of inflation is a move like that is pretty extreme, right? That we haven't seen a lot of that. Obviously, you've got the periods within the 70s and the 80s where inflation was just out of control, but
we're not the 70s and 80s thing, and I'm just, you can tell from the picture here, I'm old enough to have lived through that, but that is not really on anybody's radar screen. That doesn't seem to be a major threat. Now, maybe 15 years from now, with that big debt chart that we showed you, if that just goes unaddressed and just gets worse and worse, maybe 15 years from now that you could see that. Over the next 5 years, if you get a scare, it's going to be a moderate scare in that 3 to 4% range, which should be manageable and is not it's not the end of the world. So
Okay.
I'll finish up with the forecast if you want me to.
Yeah, but before, so we've got this last slide of Eric's forecast here. So if you have any questions, we'd love to. We've had a couple that I think we've addressed. But if you have any other questions, we'd love to help address those, or we can end a few minutes early after this last slide.
Okay. Yeah, feel free to send those in, and Chris will read them out to me. So this just summarizes everything we talked about today. For this year, we think GDP is going to show up in that 5.5 to 6% range. We're saying 5.7, trying to be very precise, but it's going to be a good number. And then next year, it's probably tapering back down and on our way back down to 2, which has been fine for all these previous years. Unemployment rate, it's going to keep dropping from 6% where it is now. We think it'll get to the low 5s, but because of some of those other things we talked about, all that slack, all those unaccounted for people that have left the labor force, it's going to keep that from dropping way back down to where we were back in the good old days. The world of the 3.5 or 3 and change unemployment rate, we may not get back there. We may not get back there ever. Fed funds, the overnight rate, LIBOR tends to be tightly correlated to that. We think the Fed is going to be okay sticking with their pledge and saying we're not moving this year. We think that'll be true this year. We think we get to late next year, the Fed is going to probably get shaken off of that. But for 2021, we think Fed funds rate stays right where it is. 10-year Treasury note, our best guess is that it has a hard time getting much above that 175 that we just hit not too long ago. Every time we get into the low 170s, it tends to drop back down. And so we think it's going to bounce around and end up the year probably about where it is, which is good. That means the housing market will be healthy. And as we already said, S&P 500, 7 to 11% this year. We're already at 9. There's going to be some choppiness. We're going to have some type of a sell-off for sure, but we think we'll still end up with a good number for this year, particularly combined with last year and the year before. I mean, the returns we've gotten from the beginning of 19 to now, it's just unbelievable what has happened. So, but we think it's still time to be optimistic. We'll think we'll get a good number this year and a good number next year as well. And that's it. That's all I had. This is a beautiful disclosure document, and I think that's been up there long enough. So any other questions come through?
Nope, it looks like we have no other questions. So we really appreciate your participation in this, Eric. And for those that have attended and are listening to this via recording hereafter. I think, Eric, you ended it well. We should get out there and we've got some smooth sailing hopefully coming. Oh, looks like we might have a question.
Somebody snuck one in.
Yeah. Let's see. Matt, can we unmute Lisa Tanner? Oh, she's asking. She's asking, how do you foresee the supply chain lending? I don't know if she's addressing Greensill and such or something else.
How do you address supply chain lending? That is outside of my area of expertise.
Yeah.
I'd throw it back to you guys and see what you have to say about it.
Yeah, so I think, just basic, so basically, Lisa, supply chain finance tends to be based on LIBOR. So like the capital finance business, which does ABL and factoring relationships, and Eric, you guys have a group that does that also. Mm-hmm. Yeah. That is typically LIBOR or prime rate based. And so that was my question before, was around, if we start to see inflation, obviously Fed funds, they're claiming that they're gonna keep that at 0.25%, which results in a prime rate of about 3.25 or of 3.25. LIBOR obviously bounces around because that's how the banks trade funds overnight in Europe. And so Eric, I don't know if you want to address to me, supply chain finance and working capital finance are all typically LIBOR based or prime rate based. Do you see that moving a ton over the next year?
We don't. It's going to be tough for the Fed to rationalize increasing rates anytime in the next 12 months. I mean, they're pledging to stay on hold till 2024, which is, I think, wildly optimistic on their part. But we would have to see economic numbers and inflation numbers that are significantly above anyone's forecasts for them to come off of that. Because the Fed's going to, and I don't want to make the answer too long, they're not going to start out their what they call tightening cycle. They're not going to start backing down those financial conditions by increasing rates. They're going to start by tapering off their asset purchase in their bond portfolio. And they could spend 6 months just tapering down their asset purchases before they ever even talk about rates. So we think you're at least a year and a half away from the Fed even hinting that they talk about moving those overnight rates anywhere.
Yeah, that's a good point. So I guess if you get to pick, for a working capital finance or a supply chain finance, you probably want to pick Fed, right? Because, prime rate instead of LIBOR.
Yep.
But I hear you on that, because they'll stop purchasing things, which will actually affect larger borrowers before it'll affect the smaller ones. Which
Yes.
Typically, we care very much about the long tail here at C2FO, and so glad to hear that. All right, we have another question. Let's see. It's how long do you see the sector rotation sticking before rotating again? I'm not sure if he's. I don't know if that's.
I don't know if he meant value versus growth. I'm not sure what he meant for sure there, or tech. That's a big story there. We're in the camp that that if we do indeed reopen, growth has rotated back into leadership. And with that, we think that that's what actually has longer term legs than value. If that's what they're asking about, value has rotated back after a long underperformance, performed pretty dramatically there for a while, but now that's tapered off. I think the growth type focus, which would be some of your IT names, your tech names, the cyclical types of names, we think that that's a better longer term strategy. To even write out some of the changes in those variations, we think it's a better longer term strategy for success and just over the long haul.
Yeah, and I read a really good paper by Karl Marx. No, that's not him.
Different guy.
Yep. Who's the oak tree guy? Howard Marks, Howard Marks, who kind of dissects, because he's a long-term value guy, and his son is a growth guy, and they through COVID, because they were housed together, basically formed a convergence of the two. And so they're arguing that the great names like Apple and Google and others are in fact value stocks. And so I would recommend that Nishard reading the paper by Howard Marks. He's the Oak Tree Capital, and he's typically a credit guy, but a great writer and great investor, and dissects the value and growth. But I think we've seen a resurgence in value recently. I know that in my portfolio, the value stuff has gone up better than tech recently, but it sounds like you're long run, you're more bullish tech. Is that right, Eric?
Yeah, value. Yeah, and if you get into some of the analytics on there, the charts on value versus growth, anywhere you look, it tells you the value is massively undervalued, and that it should be set up for a long period of outperformance. But we really take a long-term perspective. The growth has a better chance of helping you make your financial goals in the long run. So that's we're a growth tilt type of a shop.
Mm-hmm. Great. All right. Well, we are at time, and I think our questions have run out. Thank you so much, Eric, for joining us and for talking us through this. And obviously, fantastic information. And let's all, as Eric suggested, go play ball. Go
be optimistic.
Get out there. Take care.
Thanks for your time.